Hello and welcome back. I'm pretty sure you have already felt it if you are invested in the stock market, but today we had sort of like a small crash in the markets with most of the indices being down about 3%. And amidst this environment, really, I wanted to make a video and talk a little bit about a stock that I believe is a huge value right now. And I will actually also create a separate video in which I'm gonna talk about opportunities in the current market because we have been having a crashing market really and a lot of interesting opportunities for buying new stock right now. And a lot of the companies have actually been underperforming in terms of their stock price, not their operations. But they open up nice and interesting possibilities for us to buy some stock. And I would likely create a separate video for this. But today, I wanted to talk a little bit about Meta platforms or Facebook because it has reached $187 for its stock price, which I think is very, very low. And I wanted to show you some of the metrics here and also use the stock evaluation tool of our application here just to identify what kind of price makes sense based on the financials of Facebook or Meta platforms, if you like to call it like that. So as you can see here, the revenue of Facebook has been increasing overall. And in 2021, actually, they had one of their best years. As you can see, it was comparable to 2018 with a 37% increase in revenue. So doing pretty well here. Yet the company's stock has been absolutely annihilated. And as I'm scrolling below, you can actually see all the information. But what I wanted to point out here is the increase in the EPS, like the earnings per share. Look at that. It used to be 5.49 in 2017. And today is more than double that, almost three times, with almost $14 for earnings per share here. And you will see that the net income has more than doubled as well, from 16 to 39, almost $40 billion here. And the balance sheet of the company is looking even better, actually better than ever. As you can see here, the total liabilities of the company, let me find it over here. The total liabilities of the company are sitting at $41 billion, but the total assets at 166, which is like four times as much, which is absolutely awesome for the company. And the total stockholders' equity, of course, also increasing with the equity, the assets of the company increasing as well. And the total equity here is basically the same thing. Over here, there's no minority interest for the company. So the total stockholders' equity is the total equity. And right now we're looking at $125 billion for the last year, 2021. And the cash flow, which is my favorite part, you will see here amazing growth in terms of their operating activities. And this was probably their worst year. But look at 2021, 49% increase in their net cash provided by operating activities. And the company has been also investing a little bit during this market time. And also here, they have been repaying some of the debt. As you'll see here, there's some debt repayment and some other financing activities, but for the most part, they have also been repurchasing shares here. Look at that, common stock repurchased, 44 billion. That's a lot of stock that has been repurchased by Facebook. So that's great for investors. And the free cash flow of the company, look at that. That's insane as well, more than double from 2017. So the company is doing great financially. And now I want to take a look at the stock evaluation tool here, which kind of gives me all the information in a concise manner so that I can use it for my projections. And I have the three most important metrics here that I'm going to be using here. And it's revenue growth, net income margin, and free cash flow margin. So we're basically looking at these three key metrics of profitability to determine our projections for the company. And we're using both net income and free cash flow because net income tells us about the profitability of the company, and free cash flow margin is in relation to net income because we want to see how much free cash flow we're making in relation to the net income, because the company can be making free cash flow from a lot of different for a lot of different reasons, even actually offering shares to stock actually to their employees can actually increase the free cash flow, or depreciation can increase the free cash flow. So we need to actually have a relationship between the net income margin with the net income, because that is profitability, because net income means profit, basically, all the money that the company keeps. And so the revenue growth that we're going to be using for our projections, again, we're going to be using low, medium, and high projections here. We're going to go with something that's a little bit lower than the 3-year average here, because I want to be safe, especially for our lowest revenue growth here. So the lowest one I'm going to use is 20% over here for my lowest estimates, which is lower than ever before, at least for the last 5 years. And the medium one that I'm going to go with is going to be the 3-year average, which I think is fair here. And the high one is going to be 35%, which is closer to last year, actually. The net income margin is approximately the same for all the all the years. I'm gonna go with 28, 30, and 32. Oops, and 32. Now the free cash flow margin is another nice thing here. It's very, very similar, and that means that the company doesn't have any surprises really. It kind of converts net income to free cash flow at about the same rate, and so that's what we want to see from companies. And the free cash flow margin that we're gonna be using for our low projection here, let's use 90, which is the lowest, or actually it's not even here at all, it's pretty low. And for the medium one, we're going to use the 5-year average one, about 94. And for the high one, let's just use 99, which is the last year's one. And the annual return that we want to be getting from the company is 13%, is what I like to get. Anything more than 10% is fair, just because we want to be making more than the average S&P 500 ETF, which makes about 10% a year. And let's calculate here. And you will see that the current price is the maximum price is actually to pay for these estimates over here. Look at this low one, for instance. This is actually already pretty conservative here. We're looking at 20% revenue growth, 28 net income margin, 90% free cash flow margin. All of these are lower than the previous 5 years. And as you can see, the low estimate here is about $390 for this kind of projections. These are 5-year projections, by the way. The medium one is $589 for this kind of projections here. And the high one, which is the most confident, I suppose, and the most optimistic, is $850. And the current price is $187, which is way, way less than even our lowest estimates here. And this actually represents the maximum price to pay today to buy the stock in order to gain at least 30%, 13% of annual returns on our money. And so this is why I feel that Facebook right now is a fantastic opportunity, and I wanted to make just a separate video to point out to that idea and just let you know and give you some information about what the current cash flow and margins and revenue of Facebook point out to. Of course, it's at the end your decision whether you want to buy it or not. But I think that it's useful to at least know what's happening with financials, and with this kind of tool we can very, very quickly dig deeply into Facebook and any other stock really, and see what kind of valuation we are getting for for normal averages of the company that we're using here. And we can go overboard, we can use all sorts of averages and get different estimates here. But these ones, I feel that they are very, very close to reality, and if they may actually even be conservative. So that's what I wanted to talk about in this video. Hopefully you enjoyed this one. If you did like this video and it helps you a little bit, please leave a like, because that really helps the channel grow and bring the content to more people. And if you are not a subscriber, you may consider subscribing, because if you are a value investor, this is probably your channel. And if you did enjoy this video, please watch this one that I made a little bit earlier. And it is about Alibaba. And we're talking a little bit about its evaluation. And stay invested. Don't be too scared of the markets right now. And I'm gonna be following up with a separate video in which I'm gonna talk about probably like a top 10 stocks actually that I would potentially buy today at this current environment where everything is actually going down. Thanks for watching this one, and I'll see you soon. Bye bye.